Let's right at the top take a look at the NSE's performance yesterday. We had a pretty flat performance coming through there, with the NSE 20 share index having shed a marginal 0.1%. And just reading through some of the commentary that's come through this morning, it looks like activity very evenly split between local and foreign players in this market. Your assessment of the kind of activity we're seeing on the Nairobi bourse right now?
Basically, what we've been able to see is that the major players or the key movers of the market for the last 3 weeks has actually been foreign investors. This is because, one, they have a lot of better information that is well researched, so they've been able to pinpoint entry and exit strategy points into the market, and we've been able to see that they were able to pick out very interesting bargains a while back. So we've been able to see that they've been bearish and bullish depending on particular stocks and when they actually got into the market, and now they're getting out. We've been able to see that like, for example, last week, the reason why the stock market actually went up, the 20 share oil index, is because there were a lot of purchase being done by foreign investors. But we've been able to see that the beginning of yesterday, the market was actually shedding or going slow, is because they've been able to identify the kind of stocks they want, and now it's waiting again to be able to pick the next point of exit. And this raises a lot of questions in terms of why are the local investors actually coming out? Is this the right time to come out? Because from what you've been able to see, that there are a lot of interesting bargains, and this is most analysts are recommending you get into the market and you stay put.
Where are you, Steve, identifying some of these bargains that you've highlighted?
We've been able to see the key movers of the market actually in the finance sector. We've been able to see what Barclays and Cooperative Bank have actually been able to do. And this is because when you're looking at the fundamental indicators in the industry, we're able to see that most of the banks, like Standard, for example, with the new expansion plan across Africa, with Barclays Bank being able to unveil a few weeks ago the new mobile money transfer platform. So they're actually going out in new ways to be able to attract new customers, to be able to boost their loan portfolio, given the fact that interest rates actually been able to reduce, and that they bring the key issues to come out and be able to attract more borrowers, have access to the local SME industry. So you're able to see that the challenge in the market is actually key. We've been able to see that Equity Bank, for example, has been able to do a lot of shaking in the market with the new hirings in terms of based on talent, with the new investment wing. We've been able to see that the investment aspect of the investment bank in this country has been performing poorly, but with what Equity Bank has done, we've seen that it's redrawn its attention to the price of the stock market, and we've seen a lot of entry by foreign investors into this particular stock to be able to see and wait and see how it's going to perform. So with this, we're able to see that if the market doesn't cross the 4,000 mark this week, and then I think it's going to be lackluster for the next for the remainder of the quarter. Because at the end of the day, we've been able to see that foreign investors are the ones who've been able to drive up the market, and now they've been able to pick out all the bargains, and now time for them to stay back and wait for another opportunity to arise.
When it comes to the banking sector specifically, it seems like the local players really have to up the ante in terms of what they're putting on the table for investors and what they're putting in terms of their investment strategy and growth strategy moving forward, Steve. This especially with a player like Standard Chartered planning a $100 million Africa expansion push, and some of that be targeted to Kenya specifically. How do you see this shifting the landscape within the banking arena?
Actually, when you look at the Kenyan market, it's the hub of the East African region, and it's a good example for the rest of Africa in terms of being able to see how the banking sector can go. And we've been able to see that for Standard, for example, it has a different clientele. And the reason why they've actually picked the larger African market is because we've been able to see that there are other leading lights in the region, for example, KCB or Cooperative Bank or Equity, in terms of being able to dominate the local East African market. So for Standard, I think that the strategy one is to be able to look at the middle class, the emerging middle class across Africa, and specifically looking at how the middle class actually behaving in terms of they want convenience, they want available and easy accessibility to products and services. And Standard has been able to pick up the cream of the middle class and the upper class. So I think for them, it's being able to develop products and services for this particular kind of market, and they're targeting this kind of people across Africa in different countries, and for them the strategy is to maintain the same level of clientele, not take the route of other people. We've been able to see that the mobile strategy is actually weak compared to other banks like Barclays or KCB.
Let's touch in on Barclays very quickly, Steve. I mean, where does that leave Barclays amidst all of this? Because yesterday we had that share price falling back 3%, and analysts attributing that to investors, delving or moving into other stock and away from Barclays simply because of how it's rated against its peers. Fundamentally, the commentary is that Barclays shares rank lowly compared to its sector peers.
Now, basically, Barclays shares should actually be doing better, given that it has very strong fundamentals. Unfortunately, a few issues when you're looking at how the ratio in terms of operating costs, management cost, expansion cost, something is amiss in terms of management and strategy. And as the reason why a lot of people actually coming out of it, because when you look at the share price and you look at the fundamentals, the dividend yield and the ratio, at the end of the day, the performance is actually missing something out. So I think in terms of performance, in terms of marginal returns for investors who've been there for a long time, and that's like 6 months plus, they've reached the peak of its return on it. So they're looking for other better options, because unless Barclays Bank actually does something to be able to turn around its style of management and being able to, get more clients for its products and services, people will actually go out, because in terms of performance, the shares more or less reach its peak. When you compare to other banks, the other banks are actually now, heading to the optimal performance.